Hey everybody, we just got results for the third quarter from Boston Omaha, one of my largest investments and one that I've had a kind of love-hate relationship with over the past couple of years, if I'm being honest with you. Um, so I have not had a great deal of success as an investor. We'll get into that in just a minute. Before we dive in, please check out the link you see on your screen, fool.com/Frankel, for a message from my sponsor, The Motley Fool. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. And please click subscribe to my channel if you don't already. I cover this company fairly often, so keep up with everything I'm doing on here. So let's dive in. So they released their third quarter earnings. And just to kind of quickly recap, this has been a company that has not really performed to expectations for investors, to put it mildly. By dollar amount, it's actually the worst investment of my career. It's performed pretty poorly, and for good reason. They all the exciting things they were trying to do, not all, but most of the exciting things they were trying to do with the business in the past couple of years just kind of imploded. The Boston Omaha asset management business, they were going to do a built for rent housing business. They were trying to raise third party capital to really capitalize on the housing experience in the housing opportunity, and in the broadband space, they were going to raise some capital for that. Failed to gain any traction there. Ended up shutting down Boston Omaha Asset Management. They ended one of their co-CEOs ended up leaving, and now the remaining CEO is kind of really trying to just optimize the three remaining business lines and go from there. So let's see how he did. In fairness, I wouldn't be able to do this kind of recording a couple of quarters ago because now that there's a sole CEO and he realizes that shareholders want some better communication, they're starting to actually issue earnings presentations and some more details with their reports. So, credit where it's due. That's definitely a step in the right direction. I want to go ahead and share my screen real quick because this is their earnings presentation from the third quarter. I just want to go through the business units real quick, how they're doing in the three key business units. That's billboards, broadband, and insurance. And then just a couple of other notes and takeaways from the quarter. Again, I'm going to go through this kind of quick because this is just an 8 to 10 minute video, and I can't go through the entire 10Q in it. But we'll start with Link Media. That's the billboard business, arguably the most valuable of the three. Pretty solid numbers. The growth was about 6% year over year in revenue in the quarter. That's the highest ever. They're doing a good job of lowering land costs. Margins are pretty strong. It is a net profitable business, even on a not adjusted basis. On a GAAP basis, it's doing pretty well. And, solid quarter for the billboard business. They're not growing in terms of face count. If you can see right here, the structure and face count is exactly the same as it was a year ago. They're putting a few more digital billboard faces up there, but that's really it. So nothing to really complain about, but nothing to really get excited about with Link Media. The broadband, they break it into two different parts: Boston Omaha Broadband, which are the three subsidiaries, Airbeam, InfoWest, and Utah Broadband. Again, revenue is up about 5%. So very solid gross margins, which should really pay off in free cash flow. They've been saying in 2025 is going to be the year we're going to start to see significant free cash flow from the broadband business. And with an 80% gross margin as it scales and matures, it's not hard to see why. Currently not profitable on a GAAP basis, but is profitable on an adjusted basis. They keep adding new fiber passings and new fiber subscribers. So you have two categories of subscribers. You have fixed wireless, and then you have fiber subscribers. The fiber ones are the ones to watch. They're the real kind of growth opportunity here. That's management's been saying that for years. So keep an eye on that. That's really the key to watch here. The actual numbers in the third quarter don't look terribly impressive, but it doesn't tell the full story. I do expect free cash flow to rise significantly in 2025. Fiber Fast Homes is the fiber installations they're doing on newly built homes. Really interesting business. Essentially, they install fiber into a new home, and it's billed to the homeowner directly as part of their HOA dues. So essentially guaranteed revenue for year after year after year. Really interesting business idea. Still in the very early stages. You can see, yes, revenue is up 133% year over year, but revenue is $400,000. It's not really that much to get excited about yet. They're doing a good job of installing new fiber passings, getting some subscribers. They have a very nice backlog of contracted passings and subscribers. So very encouraging numbers. Not profitable, but this is still very much a growth area of the business. And I'm going to be excited to see where that goes over the next couple of quarters. And finally, in my opinion, the most impressive part of the company right now, which I never thought I'd say this when I first invested, is the insurance business, General Indemnity, which is a surety insurance business. $6.5 million of revenue, 41% year-over-year revenue growth, 67% growth in gross written premium. That is an incredible loss ratio for an insurance business. The surety business has great economics, which is why they're so interested in it. There's an expense ratio added on top of that. And when it comes to insurance, there's two ratios. There's loss ratio, which is what you're paying out for claims. And then there is the expense ratio, which is kind of the cost of running the business. But even with a reasonable expense ratio, that leaves a massive, massive underwriting margin. So operating income, it's nothing to be too excited about yet. Less than $1 million of net income from this business, but it's growing fast. It's heading in the right direction. I am actually very impressed with what they've been doing with General Indemnity over the past year or so. So those are the four major business segments, or I'm sorry, the three major business segments. Just a couple of key points I wanted to go through real quick. The Sky Harbor investment is worth about $155 million. This is the company that they sponsored a SPAC during the SPAC boom. This is the company they took public. They're keeping it. It's on the balance sheet at about a $90 million valuation just because of GAAP accounting rules. But it's worth significantly more than it is being recorded at. So keep that in mind. The company has about $29 million in cash and treasuries that it can use. That's unrestricted cash. There's some that is held by the insurance business and things like that. And they're starting to buy back some shares while it's low. As I'll mention in a second, there's almost no case to be made that this stock should be or is really worth $15 a share that it's trading for. I'll talk about that in just a second. But so they clearly think the stock is cheap. They've been spending a little bit of money on buybacks, not an aggressive amount, but they are not a very cash-rich company right now. So it makes sense that they're not breaking the bank on it right yet. Another key point is excluding depreciation. Let me see if I have that right here. Oh, there it is. This number right here, depreciation and amortization, is recorded as a $5.7 million expense. On the bottom line, if you look at the net loss, about $1.6 million. So if that depreciation cost is not a true expense, so if you back that out, this company is nicely profitable right now. If you just look at operating cash flow, about $12 million in operating cash flow in the first 3 quarters of the year. And the main reason why, if I'm being totally honest, the main reason why I am still holding on to shares is because it is cheap. This is a value play for me at this point. I have not been thrilled with how management has done over the past 2 years. Now, to be fair, Adam Peterson is just getting started as CEO by himself, and I like what I see so far. But this is a value play for me at this point, and I don't think anyone can really argue with that. The GAAP book value of this is a little under $17 a share. The stock currently trades for right around 15. If you just make Sky Harbor worth what it's actually worth on the open market, that would be $2.10 higher, so almost about $19 a share in book value if you can just record Sky Harbor at its market value. And there's a lot of accumulated depreciation that makes that book value artificially low. Without turning this into an accounting lesson, my conservative estimate of the sum of the parts value is about $25 a share. Again, very conservative estimate. So that's really why I'm holding this. I'm going to give Adam Peterson a few more quarters to really show me some results. But again, I like what I see so far. Big value play for me at this point. Nothing jumps out at me from this quarter as particularly impressive or particularly alarming. It's just kind of an okay quarter. I'd love to know what you think if you're a Boston Omaha shareholder or if you got out. I'd love to know your thoughts. I'll do my best to respond to any comments or questions individually. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.